Oh, that's like 100% annualized percent decline, almost. Well, that's an exaggeration, but almost. So that's a very big drop and a big hit to China and other economies, I would suggest. Another curious report in this last month is consumer credit, consumer installment credit. Now, I've mentioned this also before. We're seeing huge increases in consumer installment credit, the net change, 25 billion plus. Now, this is very unusual, except during periods when consumers are stretching. Consumer saving rate has dropped to 2.3%. It's very low by historical standards. It doesn't go much lower. And so what is the consumer doing? It is that the consumer is buying more necessities, probably on credit cards, on installment. And that will continue to drive the saving rate down. So the saving rate is simply disposable personal income, which I just mentioned is diminishing in terms of its growth rate quite significantly, minus consumption. And so goods bought on debt subtract from savings. We got some bad sales indicators in the month. Retail sales down 0.6% for the month of November, going into the holiday season. We got some reports. We'll see what happens when the numbers are completely tallied, but it looks like online spending might have been down, negative. Certain categories certainly were down, and that'll be a first in the history of online. So the real average hourly earnings dropping on a year-over-year basis is having an impact. Housing is also not showing any let-up. The only relief was in new home sales, up 5.8% month to month. But I'm sure that a lot of builders facing higher interest rates do not want to carry these homes anymore, particularly if they're spec homes. So they're pushing them out, perhaps with lower prices. But pending home sales are down 38% on a year-over-year basis. Now, in terms of market indicators, some very interesting ones. Let's start with equities and let's summarize the year. If you owned energy, which was up 59% last year in the equity market, you did very well. And as you know, we don't own energy. In fact, we're very negative on energy, certainly from a secular point of view. And now I would submit a cyclical point of view. Prices peaked in March at 130. They're down to 74, West Texas Intermediate. And yet the sector indices for energy sector index is reaching for its all-time highs. And if I look at this chart and from a long-term point of view, what I am seeing is a triple top in 08, in I think it was 2015, and now in 22. I'd be very surprised if it gets to a new high. Because the fundamentals are deteriorating. Demand destruction is real. China, some of the numbers that have been coming out of China are astoundingly weak. And of course, zero COVID is a reason for that. But I do believe China's been building inventories. And the reason it has been doing so is it's using the Russian war. It is buying oil from Russia at significant discounts. And we don't know how long this window will be open. The discounts reports are in the 30 to 40% range. So we would not be surprised to see inventories much higher almost everywhere in the world because of the war in Ukraine and the fears about not getting energy supplies, and China and India buying disproportionate amounts of oil from Russia. Russia doesn't have very many other places of size to sell that oil. Now, in terms of demand destruction, something interesting is happening here in the United States and probably elsewhere in the world. Many of you may have had this same experience. I was in California for the holidays, and I was taking Ubers. 3 Uber drivers were in Tesla cars, and I was asking them about Tesla. I found that curious, and they said, "Oh yeah, we're renting our cars from Hertz. Hertz is now not charging us as much to buy or to rent a Tesla, and of course that's the preferred car." And later on, we learned from Hertz that Hertz is doing this because it has learned that maintenance costs for a Tesla, and I'm sure other electric vehicles, are 50 to 60% below maintenance costs for gas-powered vehicles. Now, the reason this is important is because of a metric we monitor called electric miles traveled. Now, Uber drivers are going to travel many more minutes of the day or hours of the day than we are in our personal cars, which we just park and leave as we go to work. So what this means is the number of electric vehicle miles traveled is starting to increase much more rapidly because of this Uber phenomenon, and sooner even than we might have expected. It is also very interesting to note that oil demand seems to have peaked in 2019. There has been a lot of demand destruction based on rising prices around the world. And so it'll be nip and tuck to see if we meet that 2019 number again. I think it was, let me see, I have it here somewhere. I think it was on the order of, 100.5 million barrels per day. Now, if we're right, and I'll get into this in a moment, that number is going to drop precipitously because of autonomous electric cars. And I'll talk more about that in the innovation section. And so we believe that this notion of peak oil, which we used to, when we used that expression in the day, it was all around peak supply. We're running out of oil. Nowadays, the phrase considered more often, I would say, is peak demand. And we do believe that we're in the process of peaking out in terms of oil demand. At the same time, here in the US, we are moving toward record oil production. And once again, this year, we believe we could be the largest oil producer in the world. So again, supply versus demand makes a price. Back to equities, just one other note there. If you owned technology, consumer discretionary, or consumer services being FANG-like, the last year was horrendous. Anything in innovation was horrendous. And what I'm going to be elucidating in a moment is how much actually happened on the innovation front last year. It was pretty astonishing, and the market just ignored it completely. Now, there are different reasons for these declines. For consumer services, of course, we have the Facebooks and the Netflix being disrupted. TikTok's a big disruptor. They're also now much more hostage to the cycle. Advertising is one of the first line items cut during a recession. And this is why we think we started in a recession early last year, because advertising fell off a cliff. And that is at least a coincident indicator, if not a leading indicator.